The short-term bond fund continues with a high-quality portfolio stance. It is running a modified duration close to the maximum allowable under the category. The stance remains to run most of the duration exposure via central government bonds, because we think a demand supply here is the best poised, and we think the potential for mark to market gains is probably the highest as far as government bonds are concerned. Corporate bond strategy is largely limited to carry. There is also likelihood that corporate bond spreads remain wider, given that state loan supply over second half will also be higher, and therefore the supply of spread assets generally, wherein one can consider supply of both corporate bond and state development loans, will probably be higher over second half of the financial year. Therefore, the product continues to run duration largely via government bonds. The most overweight government bond exposure is to the 6-year government bond, while keeping obviously to the categorization cap on duration, and corporate bonds are largely being used for shorter term tenure, largely for carry purposes. Over the last couple of months, the 5-year, 6-year segment to the 10-year has flattened somewhat, which is quite counterintuitive given that we are still in a rate cut cycle. As market sentiment normalizes, we expect the 5-6 year to start to steepen again with respect to 10-year, and the short term current positioning therefore is overweight on the 6-year government bond segment.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.